It has been pointed out that private banks possess something of a superpower, that is the ability to create money. Yesterday, we talked about the threat to this power posed by the development of cryptocurrencies, and now we turn to the challenge posed by the explosion of securitization and collateralization used to create innovative products in this shadow banking sector. We will discuss the very nature of and the creation of shadow money and how they affect the stability of our financial system and thereby our economies. So, what is shadow money, and how is it different from the money that you and I have in our bank accounts? Is it in fact more stable, or is it inherently a source of instability? To help us answer some of these questions, we have Daniela Gabor, who is an associate professor at the University of West England, UWE Bristol. She holds a PhD from the University of Storli in banking and finance, and has published on central banking in crisis, the governance of global banks and the IMF, and maybe most prominently on shadow banking and repo markets. In 2016, she was an expert witness in the European Parliament's hearing on the Capital Markets Union. She will deliver a keynote on shadow banking, and we will then have a comment by Thorvald Grung, who is a retired central banker and now research associate at the Levy Institute, Bard College in the US. He worked for over 30 years at Norges Bank with monetary policy, payment systems, and financial stability issues. Before joining the central bank, he worked at the Ministry of Finance and the World Bank, and has published widely on banking crisis, monetary theory, shadow banking, financial regulation, and central bank theory. So without further ado, I'd like to give the word to our prominent speakers. Daniela, the floor is yours.
Okay, can you hear me? Nobody has ever called me before a prominent speaker, so I am kind of honored. It's a first. Can I just say it's also a very special moment today, not only because I get to speak to a distinguished audience, but because in that distinguished audience, we have my PhD supervisor, Professor Sheila Dow, who's sitting there. She was a great supervisor, and the fact that I'm here is in great part due to her, so I want to say thank you. What I want to do today is to face the challenge of keeping you awake after lunch with a lot of technical finance. It's quite a challenge. I've tried this many times. Sometimes it works, sometimes it doesn't. When it doesn't, it's my fault, so blame me. I think there are sort of two aims to this talk. The first aim is to convince you that the most important thing that is happening now in the world is the rise of market-based finance. It's a long-term structural transformation of the financial sector and the relationship with the economy, with the environment, with international development interventions. Everything that you can think of, well, almost everything you can think of is in there. So that's my main task. My main pedagogical task is to get you to read more about it when this presentation is finished and you're thinking, what did she talk about? To do that, I will try to disagree as much as possible with my dear friend Thorvald. We agree on many things, but we'll try a bit of disagreement. Okay, and in order to do that, I mean, the invitation that I received was to talk about shadow banks. I will talk a little bit about shadow banks, but I also want to frame this issue through talking about new money, that is money that is, or forms of monetizing credit that are a sort of constant feature of capitalism. So this will be a story about money and shadow money, and I'll show you in a second what I mean by that. Throughout time, when I tried to talk about shadow money and shadow banking, I tried two ways of doing it. The first one is this. Let's see if it works. By listening to Wu-Tang Clan. I used to listen to George Michael as an adolescent. I had very kind of mainstream pop interest. And now I'm getting into Wu-Tang Clan. I think a lot of what shadow banking is about has somehow been captured by Wu-Tang Clan songs. There is a song about if time makes money, if time is money, which is very interesting to explore the issues of temporality related to the creation of new money. But then I worked out what the lyrics of the song mean, and I decided that probably they shouldn't be used in polite company. The second way to talk about shadow banking is this, the more traditional established way. Some of you might recognize this. It's the famous map in Zoltan Pošar et al. 2010 paper, which I think was very instrumental. It was very important in one of the important reasons why we got shadow banking so quickly on in the international policy agenda, right? This is very unusual. You have a concept that is introduced in 2007. By 2011, you have the Financial Stability Board, a new international body that receives a mandate to address the risks in shadow banking, right? So a very quick process in political terms in international financial governance. And what this map does in some ways is to point out that there are many complicated shadow banks out there, and it invites us to try to work out what are these distinctive type of shadow banks, where do they come from. However, to give you a little bit of context, I think there is another way of thinking about shadow banking by looking at the papers, the 3 research papers that I think were the seminal papers in the shadow banking literature, mostly produced by researchers working in central banks as opposed to academia. And there, what we see is that shadow banking is defined not only through the range of institutions that are involved, but also the type of activities that shadow banking relies on. And that's very important to focus, to my mind, it's very important to focus on the type of activities, because shadow banking can be understood as the production and financing of tradable securities, right? Which is another way of thinking that shadow banking really is about market-based finance. That is finance that is organized, that organizes credit creation around securities markets, and I will argue in a second that organizes money creation around shadow money, okay? And to give you just a context to that this idea of shadow banking into market-based finance is very powerful in international policy circles. Since 2014, the Financial Stability Board is actually working towards transforming shadow banking into resilient market-based finance. So that's one of the first evidence that I want to present to you of why shadow banking into market-based finance is the most exciting and possibly one of the most challenging things that is happening in international finance. But I don't want to spend too much time on what exactly does the FSB mean there, why we have this great photo with a light there, right? It all works about throwing light on shadows. It's pretty simple. I want to ask you to think of an exercise, this building a little bit on Anne Pettifor's great talk earlier. I want you to think of this exercise. If I'm sure some of you in the audience still remember cash, although I hear in Nordic countries cash is a long-on proposition. Imagine this scenario. Every evening, you go to your bank and you deposit all the wealth you have in a bank, all the cash you have in a bank deposit. In the morning, you go and take out that cash again. You use whatever proportion of it you need during the day, and you go back and deposit again in the evening, right? So through the night, we have bank money. Through the day, we have cash in the financial system, right? It's a crazy idea. It's a very uncomfortable idea. I mean, who wants to go to the bank every evening and deposit their cash there, and then go to the bank again in the morning and do the same? However crazy this sounds, in the US financial system, we had an equivalent of this process of creating a type of money during the night and destroying it in the morning over and over and over again, to the tune of around $3 trillion through 2 important types of banks that did shadow banking activities, Bonnie Mellon and JP Morgan. Okay, so I want you to remember this, that money creation before 2008, there have been reforms since then, but money creation before 2008 involved creating a particular type of money that I call shadow money during the night and destroying it in the morning again. And we will see what are the reasons for this very intricate and, to my mind, quite mind-boggling way of temporalizing money production. okay? And the story that comes with this picture is a sort of much broader story, and it is this. Money in industrial capitalism, right, is very different than money in financial capitalism. What do I mean by financial capitalism? I mean ways of organizing credit creation around securities and derivatives markets. Okay? So we don't think about traditional bank lending directly to the economy. We lend through securities markets, and then we find ways of financing that particular type of lending. If we start from this proposition of thinking in broader terms about financial capitalism, and I would like to point out that we have had two ages of financial capitalism so far within capitalism. The one that finished almost with the First World War, and then definitely with the Second World War. That was the first global age of financial capitalism. The second one has started in the 1970s after the collapse of Bretton Woods, and it's still continuing. And I think it's accelerating. I will show you as we speak. So if we try to distinguish between money created in industrial capitalism by traditional relationship banking and money created in financial capitalism, then I think it's useful to use Hyman Minsky's definition of money. And Hyman Minsky, to me, has been the starting point for many of the ideas that I've developed in this project, which I forgot to say was funded by INET. So thank you, George Soros, an Eastern European who's grateful for the funding. If we think about Hyman Minsky's definition, and that very much resonates with Ann Pettifor's definition and many other ways of understanding money as balance sheet relationships, Hyman Minsky argued that bank money is debt, right? A promise to pay or a debt of banks that is brought into being as banks finance business, as they finance assets, loans, okay? If we use this definition, then I define shadow money, or I adapt this definition that Hyman Minsky has, to think about shadow money as debt of securities traders, and this includes a much broader range of financial institutions, some of them regulated as banks, some of them working as shadow banks. So debt of securities traders that include banks, asset manager, bond funds, institutional investors, and brokers, that is brought into being to finance tradable securities. And how it's brought into being is by using those securities as collateral to guarantee or to secure that promise to pay. Okay, so very important. And now for the exciting part, I'll show you some balance sheets in order to very quickly illustrate that definition to distinguish between bank money and shadow money, right? So this is a bank's balance sheet that has assets and liabilities. And incidentally, if I go too fast or this is very complicated, stop me. And I'll try to make it clearer. So we have a bank that has assets and liabilities. The assets is what is earning an income for the bank, and here I'm illustrating it with loans. Let's see if I can do this, yeah. I'm illustrating it with loans. So following Hyman Minsky, bank money is created when the bank issues a loan, right? Which is now a pretty standard way of understanding bank money creation. Bank of England supports it, so we don't need to have a long fight about it, as we used to have in the 70s and 80s. In comparison, shadow money creation occurs when this bank finances a portfolio of securities. This can be government bonds, this can be asset-backed securities, mortgage-backed securities, corporate bonds, by issuing a promise to pay, by creating a liability that is secured or collateralized by the very securities that it is funding, right? So very important in the traditional bank money creation story, in a sense, loans and bank money are separated, although they are simultaneously created. Their afterlife doesn't depend on or depend on each other, whereas we will see in the shadow money creation story, the assets and liabilities of this bank that is funding credit creation via securities markets are very closely linked, okay? And this gives a sort of a flavor to the work that Zoltan Poscharen, I'm drawing here a lot on the work done by Zoltan Poscharen and the INET school of shadow banking / shadow money. This gives a flavor to the idea that shadow money begins where broad money, that is the liabilities in red of the traditional banking story, where broad money or M2 ends, okay? So what I want to do in this presentation, and I already feel like I've spent 40 minutes of it, but bear with me, is to ask 3.5 questions and then try to answer them. The first one is, why create shadow money? So what is the reason? What is the driver? What is the theoretical story behind it? How is shadow money created? By whom? And very important, who backstops it? And this is where Thorvald and I have our disagreements of how and why should it be created. And since we are in Norway, where everything seems to be stable, I will try to persuade you that 10 years after Lehman, you should care about this. Not only in sort of general terms, but as potentially a dystopian, I'll venture to say, as a potentially a dystopian future that is ever closer. So why create shadow money? When I present this paper and this work, people say, well, but you can buy a burger, right? If you can buy a burger, or you can buy Anne bought a very expensive cappuccino this morning. If you can buy a burger or a cappuccino with this type of liabilities, it's not really money. I mean, that is true. You can't buy a burger, not yet, although I can imagine some ways in which blockchain would allow you to buy a burger with a repo or with a shadow money. But that's, if we go solely by this framework or by this question that if you can't buy stuff with it, then it's not money, all the interesting things that we can ask about new monies disappears, right? So I will follow Keynes, who, in writing in 1930 about bank money, the traditional money creation story that I just showed you, he argued that bank money is not real money because it acknowledges, but it doesn't distinguish debt, right? So following Keynes, of course, for now, shadow money does not distinguish debt. That is, you cannot buy burgers or cappuccinos with it, but it acknowledges that, and it helps finance securities, and therefore it helps create credit through securities markets. So why create shadow money? What are the drivers behind it? And I didn't want to sort of bore you with numbers, but the numbers are quite big. They used to be before 2008, before the collapse of Lehman Brothers, in stock terms, around $8 trillion in the US, or in dollar-denominated shadow money, around another 8 trillion to 10 trillion. It's very difficult to measure them because we don't have good statistics in the euro area. And I will argue towards the end, China is the newcomer to the shadow money story, and Chinese shadow money is big simply because the Chinese financial sector is very big. Okay, so why create shadow money when we know it's big? And the answer is, drawing again on Zoltan Poschar, is that shadow money does something that bank money doesn't do anymore. And it doesn't do anymore because of structural or evolutionary changes in finance. That it connects demand for safety with demand for leverage. And the demand for leverage story is pretty simple. I mean, it's something that is very standard to sort of historical accounts of capitalism. What we have in capitalism is a tendency to try to monetize credit in new ways, to create, to innovate new financial instruments that allow the expansion of balance sheets and the creation of financial and, to some extent, real profits. Why do we want to monetize credit in new ways? Because monetizing credit in old ways, that is creating bank money, is expensive. Here I disagree a bit with Anne. Creating bank money is expensive for the banking sector because there is a social contract around money, and the central bank and the state doesn't allow money creation without imposing certain costs to it, the cost of central bank reserves and all sorts of forms of regulation. So the impulse in capitalism is to try to monetize in new ways credit in order to escape the state, right? You want to get away from the state because it's cheaper and you get higher yields. The other side of this story is that you monetize credit in new ways because there is a demand for somebody to hold those new types of liabilities. That is, there is a demand for safety or for safe vehicles, say financial instruments, that can credibly store value during good and bad times. So if you think about your own experience as a retail consumer or as a household, our preferred store of value during bad times is a bank deposit, right? You want to hold your wealth in cash because you know up to a certain level there is a deposit guarantee. And so therefore the state promises to give you back the money that you have lent to the bank. But if you're an institutional investor, if you're a very large pension fund, if you're a sovereign wealth fund, then a bank deposit is not offering you a safe vehicle in which to try to store value during bad times, and therefore you have to go and try to find it somewhere else, right? Because of the deposit guarantees and other reasons. So there is this pressure, or there are these parallel forces of trying to build more leverage in the financial system in order to get new profits, and trying to find new vehicles where to credibly store value during bad times. And these latter pressures have to do with changes in the shadow money story, with changes in the structural features of the financial sector towards a market-based ecosystem, right? And I'll talk a bit more in detail about it. The second question is, so we talked about why create shadow money, and it's a pretty standard story. How is shadow money created? This is where the story becomes much more technical, and I think in order to tell it, it requires us to think not about money, but about moneyness, right? And what is moneyness? I define it as the ability to convert any kind of liability into state money at par and on demand, right? Which is, I hold 100 pounds, since I live in the UK, I hold 100 pounds in a bank account with Royal Bank of Scotland. I want to know that whenever I go to Royal Bank of Scotland and put in my PIN, they will give me 100 pounds in cash back, right? So this is very important to me. The moment that I stand to lose, to make some losses, or to have a haircut like they try to impose in Cyprus, my faith in bank money disappears. My faith in bank disappears because I know this bank deposit doesn't store value credibly anymore. The same idea of moneyness applies to new types of money, new forms of monetizing credit. The idea of trying to monetize credit is to try to make a credible promise to store value, that is, to convert at par and on demand. Okay? For a bank deposit, it's easy because the state says yes, up to 80,000, 100,000 euros or $250,000. I guarantee that there will be a one-to-one par convertibility. But for promises to pay made in the shadow banking sector, there isn't this state guarantee, precisely because we're talking about shadow banking, right? The whole purpose of creating new types of money is to get away from the state, because the backstop of the state is expensive. So what do you do when you don't have a state guarantee? Well, you play with collateral, right? Remember, these securities, when I as a bank, or when the bank in this story is creating new shadow money, it's giving out these collateral, these securities as collateral to whomever is holding the shadow money, okay? So very important. The story of shadow money is a story of what happens to collateral on a day-to-day basis. And I argue, and you can trace this quite closely by looking at how these financial contracts are organized. And here we can have a long conversation about accounting. I don't want to do it now, but there is a very clever distinction between accounting, economic, and legal treatment of these promises to pay, to make sure that they are both a credible store of value and they enable leverage. If you want to ask about it, I'll tell you more. But moneyness, or the credibility of par convertibility, comes from daily collateral valuation. That is, in this story, whoever is holding that shadow deposit and the bank that issues them calculates the value of the securities that was given as collateral on a daily basis, right? So if, for example, I created a shadow money worth 100 euros, and I gave 100 euros worth of German bonds, 3 days from now, if the value of German bonds has increased from 100 to 120, I, as a bank, have a problem, right? Whoever is holding my collateral has 20, the difference between 120 and the 100 I promised to pay back. It has 20 of collateral that is mine, right? And I want it back. I want it back because I only promised to pay 100. I didn't promise to pay 120. So what happens in the system is that whoever loses or gains from changes in the daily price of securities has to pay back. So if the price of my German bonds has gone from 100 to 80, or if your Greek bank during the European sovereign debt crisis, the price goes to 30, now you have a problem because you promised to pay back 100 euros, but you only gave out 30 euros of collateral, okay? So you have to come up with 70 more. This is why this particular type of agreement works as money. So very important on either term shadow money, or term repurchase agreements, you have collateral valuation. On overnight, if you renew them every day, the same logic of making sure that the market value of the securities you gave out is equal to the promise you made to pay out. That is what binds and connects the system and this new money together. So what we have here, and this is why Wu-Tang Clan is useful, because I'm writing about time and money. What we have here is an effective shrinking of monetary time, right? Even if you look at promises to pay that are made with collateral that is issued for a 3-year bond, and the promise to pay is made for 3 years, time for the financial institutions who have made that promise and who are holding it is measured daily. And now, increasingly, is measured intraday. You can have intraday collateral calls. So it's time is shrinking because the pressure of moneyness is to make sure that the faster things are happening in the financial system, the more you want to make sure that the promise to pay is always equal to the value of collateral on that moment. And there is a sort of growing literature looking at the importance of shrinking time in monetary systems that says, well, our idea of how finance works has to change quite dramatically, because even long-term financial institutions that look like patient institutions, like a pension fund or an insurance company, actually are much more reliant and exposed to daily variation in the price of securities. And that has to do with their derivative positions, and also it has to do with the fact that they either finance their activities through shadow money, or they finance shadow money creators. So who creates shadow money? And this is where the what are shadow banks part comes in. Now, the interesting thing about this, of thinking about shadow banking as a monetary process, is that you start to see a much broader range of financial institutions that are creating or monetizing credit in new ways. And that opens up a lot of interesting political economy questions and questions of financial power and questions of social contracts around money. So who creates shadow money? The typical suspects are there: hedge funds and bond funds that are financing assets, securities, by issuing promises to pay back by those assets. Then you have institutional investors, including sovereign wealth funds that are involved in this space, asset managers like BlackRock, even pension funds. I always thought that pension funds were the ones who were looking for safety, and so they were the holders of shadow money. But I've discovered that in Canada, that has one of the largest pension fund system in high-income countries. In Canada, pension funds are actually taking leverage by creating shadow money. So if Canada is setting up the system for where we're going, or the path for where we're going, it's a much more exciting for me as a theoretician of shadow money system. Then banks are also creating shadow money. I mean, our idea of banks as very simple, traditional financial institutions should be changing a lot. There are small banks like saving banks that we discussed today, but there are also large banks who, besides creating traditional loans, they're also making markets in securities. That is, they are helping organize the creation of credits through securities markets by promising to buy and sell securities on a daily basis. Whether they do or not is a different question, but they are there. And here we can tell a story about endogenous shadow money creation. I don't want to go into it because it would require even more monetary theory than I'm heaping upon you now. But there is an endogenous story there. Then we have broker-dealers and CCPs, or central clearing counterparties. The latter ones are the kind of the most exciting development in the shadow banking space that have to do a lot with the financial reforms after 2008, because they are the ones that are connecting the derivative space and the shadow money repo space. And I've discovered recently, Bitcoin is here as well, and there are initiatives to think about Bitcoin as a starting point of organizing securities markets through blockchain. I've just said those sentences. I do not know what they mean, actually, but I will work it out at some point when Rohan, I don't know where he is, when Rohan explains to me how blockchain can help securities finance. But for now, repo is there. UBS is trying to do shadow money in the crypto space. To give you an example of how pervasive and how, and then to start to talk about fragility, right? Because this is why we're here at the end. We want to know how the system is fragile, not how the system operates. So far, I've told you how the system operates. This is from a 2017 Bank for International Settlements paper that is illustrating the concerns of a large European asset manager, right? So an asset manager takes funds from institutional investors and then it puts them somewhere, right? Invest them on behalf of the institutional investors. And there is a lot of debate of whether we should think about asset managers as systemic or not. If I tell you that BlackRock, who has a balance sheet of $7 trillion US, has convinced the FSB that they are not systemic, then you will you'll have a sense of why we should treat them as systemic. If we look at this balance sheet, what it shows us, so on the left-hand side, is that asset managers are lending to shadow money issuers, or used to lend to shadow money issuers, quite significant proportions of their cash, right? So they were holding their cash in shadow money or in a repurchase agreement. And BIS is worried that this proportion has been shrinking quite significantly over time because of regulation. And why it's worrying is interesting to work out from this part of the graph from the right-hand side. And what this part shows us is that shadow money creation is fragile because, as I explained earlier, the moneyness or the credibility of this promise to pay that is backed by collateral relies fundamentally on daily changes in the price of securities, right? So, and everything is good when securities prices go up, because the creators of shadow money get more securities back, and they create more shadow money, then they get more securities back, they create more shadow money, and everything goes up, right? But then, as everything goes up, everything can come down again, and we know this is a pretty standard experience in financial capitalism. You have financial instability. And when the price of securities starts to fall, then shadow money becomes very fragile, right? Because you have to find additional collateral or additional cash to prop up your promise to pay. And what we see here, and it's a point of debate on what this signifies, whether this asset manager had to pay more cash out or received some cash. Nobody can tell me, so if you know anybody who works at the BIS and is willing to disclose what is happening to this asset manager, then that would be great. Well, when you see 50% in margin calls, then you think, oh, this is serious. 50% in margin calls is very large. It means on a daily basis, 50% of your cash has to flow out or has to be, you have to find it somewhere, and finding cash during bad times is very difficult if you don't have it. Okay, so we go now very briefly into how is this system fragile and who takes responsibility, since it's so large and so important for financial systems that are organized around securities markets, who takes responsibility for stabilizing it? So the main fragility, and this fragility was already in Minsky, he's written quite a bit about it, to my surprise. Kindleberger has written quite a bit about it. I, for a long time, didn't know where to look. But shadow money creators are exposed to daily changes in the price of collateral securities. That's a simpler way of saying that the creators of shadow money or this system is fragile because it moves with the rhythms of secondary market liquidity in securities that are used as collateral. And if there is one thing that we haven't solved, and I doubt we will, but if there is one thing that we haven't solved since the global financial crisis, is that we have no idea of how to preserve liquidity in secondary markets during bad times. Central banks don't know that, although arguably Bank of England is trying to do certain things, but we have a system that is reliant on a concept that we haven't worked out very well yet. When shadow money becomes fragile, then it can have devastating consequences, not only for private securities that are used as collateral, And this is the standard story, if you want, of the collapse of Lehman Brothers and the collapse of asset-backed securities and mortgage-backed securities. When these started falling in price, Lehman Brothers had to find new collateral or new cash. It couldn't. It was funding itself with shadow money. It went bankrupt. But if you look at the story of the European sovereign debt crisis, what we see is, and this is much more contentious, and there are many disagreements here, but I stand by my research, what we see is that a system of European shadow money or shadow euros that we had in the euro area before 2008 is what created, or if it didn't create, at least it accelerated the sovereign debt crisis. So when you think about shadow money and you think, okay, this is very interesting, but it's super technical, and what do I care? Well, if you're a European citizen or a citizen of the euro area, you should care, because beneath the layer of austerity politics lies shadow money. If you want to understand why we have austerity politics in Europe, I don't think you can leave this part out of the story. It's not typically in the story, because try to tell this message to European politicians. I struggle, but I try. But I arguably, and I have a graph to show you here, but I won't yet, because I have to clarify the role of central banks. What we have seen in Europe, the reason why we had the European banking crisis morphing into a sovereign debt crisis is because European banks were financing themselves with shadow money. The ECB did not have a mandate to backstop shadow money, although it pushed for its creation. And because it didn't have a mandate for backstopping shadow money, and why it didn't is obviously the answer is Germany, as almost any question related to the ECB has the same answer. The reason why we had the European sovereign debt crisis is because our understanding, and I'm going to the next point, am I doing 5 minutes? Is that what we know of crisis central banking is completely wrong when it comes to shadow money. Okay, the implications of shadow money for our understanding of the role of the central bank as lender of last resort are fundamental and fundamentally misunderstood, I think. And I will just say this very quickly, is that lender of last resort liquidity support during financial crisis is now done through shadow money. That is, banks issue shadow money in order to borrow from the central bank. If the central bank follows the same moneyness logic, that is, it does the same collateral valuation, it has the same collateral valuation practices as private shadow banks, then what you get is a central bank that is actively destabilizing the system during crisis instead of stabilizing it. It's very ironic. It's not easy to prove, in the sense that you need to have access to the data, particularly the data of the ECB. The Bank of England and the US Federal Reserve are not in the same situation, because they are not the central bank of a monetary union. They are the central bank of one government, and they are very happy to backstop that government if shadow money threatens to destabilize it. But I just invite you to look at this graph. This comes from a Banque de France paper. The Banque de France paper argues the opposite of what I'm saying, I think, for reasons that have to do with politics rather than economics to some extent. But what you see here is, remember I said give calls and collateral valuations when the price of securities falls, right? So everything under zero is banks having to give more money to the ECB in order to preserve their existing loans, right? So this is mark-to-market or collateral valuation during up to, and you will notice this is January, you will notice where this starts to peter off, right? It's when Mario Draghi comes to London and says, whatever it takes. Mario Draghi says whatever it takes, and if you look carefully at whatever it takes means in terms of shadow money, whatever it takes means I will stabilize shadow money, right? This is how I interpret the incredible effectiveness of a policy that was never implemented. We have to remember this. The outright monetary transactions provided financial stability after 3 years of instability, but it's something that actually was never put into practice. Now, this is mind-boggling to me. We have 5 rounds of long-term refinancing operations. They don't work to bring financial stability to the euro area. Then you have a central banker sitting in front of an audience of bankers in London. He says, I'm going to buy some government bonds, and then everything stops, right? Why is that the case? Well, the case is because it stopped the destabilizing, what we call liquidity spirals, that were affecting shadow euros and that were pushing the shadow euro creation towards more and more fragility. And you see here, once we get the ECB promising to prop up securities prices, in other words, promising to prop up liquidity and to stop the margin calls on loans with the ECB and on loans through shadow money, then you see the system starts to stabilize. And here, then you have QE that could have stabilized the system, but it was impossible to do. So what we have here, and this is a very important political implication, is that doing central banking or crisis central banking in the traditional way is destabilizing, and you have to do central banking otherwise in order to accommodate or to backstop new types of money. And what does that mean? Well, it means doing market making of last resort, and Thorvald will tell you everything about why this might have some very might come with some very complex social and political questions, okay? Very quickly, and I'm going to finish now, why should you care about this story, and why should you read more about it? I mean, well, for one, because we are celebrating 10 years after the collapse of Lehman Brothers in September, and both the collapse of Lehman Brothers and the European sovereign debt crisis, to my mind, can be narrated as crises of shadow money that were not accommodated by an institutional arrangement that could provide safety and could extract some demands from shadow money creators, right? That's very important because if you think about the historical evolution of bank money, for example, then you will see that bank money or bank deposits did not become money out of thin air. They became money out of a political, historical struggle in which, at the end, the state said, okay, I'm going to do a social contract with banks. Part of the social contract is that I'm going to allow them to create money, and I'm going to allow this money to settle debt and to settle tax obligations. But in return, I'm going to impose some rules and some regulations on them. With varying degrees of success, we know, but at least we did have a social contract around bank money. We don't have yet a social contract around shadow money creation, although we have disparate initiatives in order to try to tighten the ability of shadow banks and banks to create shadow money. And I'm talking about Basel III liquidity and leverage rules. I'm talking about the Financial Stability Board initiatives. I'm talking about the US supplementary leverage ratio. But the tendency 10 years after the financial crisis is to water down these initiatives. And you think, oh, well, is this because Donald Trump has come in and he really is the kind of guy who just waters down everything? But I think it's wrong to look and to find the source of all problems in Donald Trump. We have a much more complex and structural process of policy engineering market-based finance in high-income countries and in developing countries. And if you look at the recent Chinese initiatives in order to advance the renminbi internationalization agenda, what we see here is a very clear pressure from international institutions, both the IMF and the World Bank, but also private finance, who is arguing, if you want us to use renminbi in the same way that we use the US dollar, then you have to liberalize shadow money creation, because so far China is holding a pretty tight grip on how you can fund securities through this type of money. But the pressures are, and it's something that remains to be seen, the pressures are for China to move much more towards the kind of financial system that we had in high-income countries before 2008. There are lots of debates around the euro architecture. I don't want to go into it. I just want to make this final point that I think we live in an age where we will get much more of market-based finance than we used to have. And this market-based finance organized around securities market does come with shadow money, so we need to think more about it. And there are a couple of sort of indications of that. I've seen recently lots of noises coming out of Washington, particularly from IMF World Bank quarters, and the noise says, the truth is that high-income countries don't have money for international aid anymore. our poverty agendas, our environmental agendas cannot be met by scarce state resources. So what we will do is we will leverage the resources of the private financial sector and put it to good use, right? We'll do impact investment, for example, for pension funds. And to do that, we will create more market-based finance. We will create securities so the private financial sector can buy them. And there is, for example, a G20 proposal to create an asset class out of infrastructure projects that is being discussed as we speak. And also a couple of weeks ago, I went to Brussels for their Sustainable Finance Conference. This is a new initiative of the European Commission. And the new initiative of the European Commission is in the tradition of the pre-2008 initiatives of the European Commission that say, oh, let's work with finance to create some nice harmonious developments in European finance and in European growth. And the idea of the sustainable finance agenda, and this is linked to some of the things that we're discussing in the previous session, is we have to reorient capital flows from the north to the south in sustainable investment. We have to mainstream sustainability, governance, and there was another one, something with social issues, into investment, and we have to foster transparency and long-term approaches, and all these promises will be met through market-based finance, right? Or through the creation of green bond, environmental bonds. There is a long list of things that end in bonds that the European Commission wants to do in order to connect northern institutional investors with southern farmers, southern environmental projects, and people who want to cross roads through or pass over rivers through a bridge. So I think I will stop here. Just to note, read more about it because the dystopian future is knocking at the door. Thank you.
Thank you for the invitation, and thank you for being here and listening to Shadow Bank and Shadow Money. My talk would be complementary to Daniela's. We've worked on this both for a couple of years and had some discussions. I think we share very much of the same sort of backgrounds and references, as you will see. But maybe at the end we will have some slight disagreement. What I will do first is just to give you a very brief background, and then I'll talk a little bit about what is shadow banking and definitions. Then I'll touch on Daniela's approach, collateral-based shadow money, primarily, I should say, based on her very excellent paper that I encourage you to look up on the website. It's quite technical and a bit complicated, but it's worth the effort. Then, as Daniela announced, I will discuss the role of central banks in all of this, and then at the end, I would like to draw the attention back to some border issues in terms of whether the direction that you are seeing in the EU and all this other market-based finance is where we should go, and sort of ask the fundamental question of who should issue money. Just a little bit of background. As was said, I worked in a central bank for more than 30 years. I had the privilege to work at Bard College in the US. This is the picture of it. It's a beautiful building, and this is actually a picture of the summer school. I know some of you have been there for the Minsky summer school. The background for me being there was that I started getting interested in Minsky while working at the BIS for a short period, and started reading about him, and I had the opportunity to work there for a full year in 2011-12. And Minsky actually ended up at the Levy Institute at the end of his life, and so he did work there, and he has been a great inspiration for me and for many others. And also, as has been repeatedly referred to, the money hierarchy thinking, and MMT theory in particular, comes out of the Levy Institute. So in addition to Minsky, his colleague Randall Wray and Stephanie Bell, now Stephanie Kelton, are key persons in having developed this view of money. And so this is something that Daniela is also referring to a lot in her paper, and as has been mentioned before, Minsky said everybody can create money, the problem is to get it accepted, and this is where we have a link to some of the discussion yesterday on cryptocurrency, on central bank digital currency, and who should issue money, and I'll get back to that question at the end. Shadow banking is, in fact, not anything new. If you look at the history of economic theory, you see that there has always been this preoccupation with different forms of money and which type of money is accepted or not. This is a favorite quote of mine from Henry Thornton. He wrote a book in 1802 actually discussing this. And the idea is that when we are in good times, things look bright, and you're willing to accept promises from your neighbor or from a store or a business association, and then suddenly when things collapses, the same goes with these near monies, and so a big part of the discussion about monetary theory of money, I should say, is the relationship between the different types of money in the hierarchy of money. And as Daniela also mentioned, the current system whereby you are able to use bank money didn't come out of the blue. It was a long historical process whereby there became an agreement that between the state and private citizens that these institutions are allowed to issue money, and you have deposit insurance, you have regulation, you have other things that makes money what they are, and so there is a long there are many other things we could refer to in this history of money. Hayek was also mentioned yesterday. A key question then, if we look at these monetary, the different type of near monies, is which monies should be converted at par, and as Daniela again explained quite nicely, the discussion about shadow money is centered around this key question. Is there moneyness in them, and who should guarantee that? And this quote from Hayek is again alluding to this question of money can be accepted in good times, but at a certain time when confidence breaks down, should the central banks actually validate these monies? Sorry. Oops. There we go. Again, my background to this is not from academia, but from practical central banking. I worked for many years in the Central Bank of Norway, and part of the time on the questions of crisis management and what central banks should do in a crisis in terms of providing liquidity. And when the crisis hit, we saw what actually happened. We had a lot of discussions and theories before the crisis as to what should we do, the budget rule in terms of, lending at good collateral at high interest rates. But when the crisis hit, in fact, as Daniela also pointed out, there was a tendency to just sort of, give the money away at very low cost. And if central banks actually had insisted on higher haircuts on collateral during the crisis, that would have been destabilizing, as mentioned. So my work at Levy on this was related to this key question that is central to Daniela's work as well. Should central bank take on the role as market maker or last resort, which is often abbreviated to MMLR? And some of you might have read work by Perry Merlin or watched his online course, which is excellent. And he has this book, The New Lombard Street, where he advocates, that the central bank should definitely take a larger role related to the creation of shadow banking money. So that is, sort of my entry into this discussion about shadow bank, and it's, as Daniela said, it's remarkable how it's really taken off and become a very key question of the regulatory agenda. Very briefly on what is shadow banking, I think we need to just step back a little bit to sort of sort out some of the different approaches to the definition, because it can be confusing. It is certainly not easy always, and there is a lot of technicality involved. I've just included the definition here that was again alluded to by Daniela from 2007. Paul McCulley was a senior executive at PIMCO, and what is not on the slide is that he was a very keen follower of Minsky, by the way, and he was frequently at the seminar and visited the institute. And he had a speech at Jackson Hole, which is a sort of a place where central bankers gathers in 2007, where he said, loosely defined, a shadow bank is a levered-up financial intermediary whose liabilities are broadly perceived as of similar money goodness and liquidity as conventional bank deposit. Again, I remind you of this question of moneyness or money goodness that Daniela also referred to. That is, how easy is it for you to convert your claims into state money? If you have a bank deposit, that's guaranteed up to the deposit guarantee limit, so that's par value. But the question we are faced with here is, whether these shadow bank liabilities are in fact as good as money. So this was the initial definition, and note that he is referring to institutions, loosely defined, because we are here also discussing shadow money and shadow banks. So shadow banks in this setting is an financial intermediary. The FSB Financial Stability Board was tasked by G20 to work on this, as again Daniela said, to sort of put light in the shadows, because it was perceived that this was, one of the main causes of the financial crisis. And this was their initial definition. And again, as you can see, they focus on entities, but after a while, they also included activities. And as Daniela said, activities is important, because if you only look at the institutional sectoral breakdown, you sort of miss the point here. And I think this is actually where Daniela and I agree completely, because my initial work was, following this official institutional, approach to shadow banking, which really didn't make much sense. This is a picture, and I'll, take it very briefly here, but just to show that still the official approach is very much institution driven, and what this is a recent report by FSB, and this shows where the shadow. Where is the marker there? This is their way of defining shadow banking. I'm coming to shadow money in a second. So you start with the financial sector, which is quite big, and then you have what they call MUNFI, which is actually non-bank financial intermediation. So you distinguish between banks on the one hand and then shadow banking on the other hand. But you start then with all the non-bank financial intermediaries, and then you have a subsector which is called other financial institution, which includes things like hedge fund, sovereign wealth fund, money market funds, and so forth. But not all of those are actually involved in activities that are a problem for financial stability. So FSB then, take a narrow view and say that, well, all of these are shadow banking activities and a little bit of this other one as well. And this, this leads you into some sort of complicated discussions of whether insurance companies or pension funds, which are actually regulated entities, should be part of the shadow banking definition. I won't say too much more about that, but then I'll just quote somebody here who makes this transition to the view that I share with Daniela. I mean, this is again from my older paper, but Adair Turner used to be the head of the FSA in UK, and he said we need to understand shadow banking not as something parallel or separate from the core banking system, but deeply intertwined within it. Again, reflecting Daniela's view, I think this is sort of, you misses the point if you think that shadow banking is somehow something completely different from banks, because banks do have a role. I should like to add as a footnote that banks are different animals in different continents. So in Europe, we have a universal banking model where broker-dealers frequently are part of a broader banking group. In the US, they tended to be, at least before the crisis, separate entities, and therefore, this is somehow related to the institutional setup. And let me just briefly mention this other quote. The key thing here is, if you read it, I won't quote it, is the relation to the bankruptcy law and regulation. Daniela really alluded to this, and in fact, it's actually awful if you look at the changes that has been done over the year to facilitate short-term speculative financing. It's been a development that gradually has sort of made these claims more secure at the expense of other creditors, and it has actually fueled up the shadow banking money creation. Okay. This is the famous figure that Daniela has as well. It feels like I'm sort of duplicating you here, but we are at least on the same wavelength. And again, this is, the key question for shadow bank and money and shadow money is collateral use and intermediation, and also these technical uses, if you're into finance, of use and reuse of collateral, and rehypothecation, and the fact that you can actually double up on some of these collateral practices and actually enables you to leverage and leverage and leverage, which makes the system quite unstable. Okay, just 3 slides on what I perceive to be Daniela's sort of broad take on collateral-based shadow money, which I sort of basically agree with, but I have some questions regarding the differentiation here. Shadow money, according to you, is repo liabilities, promises backed by tradable collateral, frequently or preferably government bonds, and this makes the connection between the sovereign bond market and the shadow money market. Banks in this model are at the center of shadow money creation. It's somehow strange, right? If you look at the FSB discussion, because then, banks has absolutely no role in the shadow banking sector. And then you come along and you say, well, banks are key to this. And so, I mean, in the future, I think you should somehow relate to the official and sort of point out where you disagree and why you disagree, because, otherwise we have parallel discussions. You also make a distinction between, I should apologize for the abbreviation here, asset-backed commercial paper and money market funds, saying that repo is really at the kernel of shadow money creation. And these other, what FSB would call shadow banking activities, are somehow distinct and different. I'm not so convinced that that's necessarily a good difference there, but that's a minor point. A key point, though, is that government debt is needed as safe assets, and that actually you could think of this as sort of, I think it's sort of putting the thing upside down in the sense that I think of government debt as financing, real investment in roads and hospitals and education. And here you have a system which I find somewhat awkwardly is asking for government debt because they need it as safe assets for their speculative activities. Well, where have we come, I mean, that's really strange. But there we are. And I agree with you that the system as it is set up really presents new challenges for central bank, which again was the reason I started looking at this in the first place. We agree that the system is very fragile because shadow money connects money markets with securities and not the least derivative markets. Derivative markets, by the way, doesn't enter into the FSB story. It's rather weird. So the derivative markets is a huge, very, very fragile system, and it has absolutely no role in the FSB discussion about shadow money. Repo claims are critical to the generation of liquidity in collateral markets. That's, again, a quote. But moneyness of repos depend on continuous collateral valuation. Again, this is what you said. And I think this is the key, in the sense that, you had your beautiful figure. You go to the bank and you deliver your money in the evening and you want par value or at close at par value you can get. And then, you take it out in the morning to speculate intraday. That's the system we've got. And what you advocate, and where we, I think, may have a discussion, is that this system is there to stay, and therefore we need a new social contract for shadow bank money, as we have gotten over a 100-year period for bank money. And so collateral market liquidity is critical. Again, central banks need to backstop markets. And we need a formalized coordination between central bank and treasury and debt issuance and debt management. It's interesting, by the way, that the whole discussion of central bank independence comes in here, and you can ask, how that would go if these two institutions, treasury and central bank, don't coordinate. Okay, very briefly then on the role of central banks. As I said, I started looking at this because I observed what was done during the crisis, and the key question was really what the Fed did in the US, which evidently was very positive given the extent of the crisis at that time. Was that something that should be replicated? Was that a good model for how central banks should act in the future? And as you alluded to again, Bank of England under Carney has actually taken the lead and made this more or less their official policy, recognizing the importance of core funding markets and actually saying that we are open to business, we will help the markets if there is a problem, and we will backstop them. This is just a reference to an interesting paper by the Bank of Canada. Because the question is, which markets should the central bank backstop if they're going to go beyond their natural, remit of doing only institutional backstopping. And they mentioned sovereign debt, repo, securities lending, unsecured short-term bank debt, and foreign exchange. Quite a bit, if you ask me. And the question that I leave you with here is what I've been sort of struggling with for a long time, which is really that after the crisis, we had a long discussion of, with Basel and crisis resolution rules and so forth. Central banks should not use taxpayers' money to bail out systemic banks. That was sort of the lessons learned, that, this was not the role and it should be limited. But with this new policy of market making of last resort, and I said, why should they then commit taxpayers' money to underwrite systemic markets? So that was my key question in 2012, and it still is, I'm pondering about, whether this is the right thing. And so what I'd end with is going back just 3 steps to the basic issue in terms of, whether we have a system that we're happy with. I'm not sure if you sort of favor market-based finance of bridges in Africa, but I do think that there are certain aspects of this which is neither desirable or necessarily a good thing. And so we need to question the way finance has been organized. Anne Pettifor, if she is still here, advocated control of capital flows, which I sort of sympathize with. But the question is, again, do we need to do something else with the financial system? And I'll just leave you with, a thought here based on a book that I recently reviewed, which is called The Money Problem by Morgan Ricks. He is an American lawyer, and it's a very interesting book if you get a very good perspective of the current discussions and possible solutions. I don't necessarily agree with all of his proposals, some of which, by the way, go in the direction of narrow banking, but not necessarily, replicating the idea by Kumhof. But he actually said that, freewheeling money issuance by non-licensed shadow banks was a major factor behind the global financial crisis. And he asked this question, what's the use of a banking license if everybody else can go out and issue money without being sort of punished or put in jail or whatever? And said you have all these shadow banks and they are not subject to supervision. They have no, or at least they didn't have much of margin requirements and regulations, and they can issue money, in buckets. You really have endogenous shadow money creation. And so he has a solution where he actually wants to restore the privilege of money creation by saying that, if you're a bank, if you're a licensed bank, and that could include some of the current shadow banking activities or institution, you are allowed to issue money, but nobody else can do that. In addition, you will have a different type of financial regulation. You would not have very complicated Basel rules, but you would have portfolio restrictions, and you can't, you can only invest in such and such. But the important thing is that he would like then to restrict debt issuance, short-term debt issuance, by all the others. So he would actually ban shadow banking, and you will be dead, and market finance would vanish from the earth. Now you can ask whether that's a realistic proposal, but at least, and his take on it is that we better try something because we can't live with the current system. But I encourage you to read the book. It's quite fascinating. And I just want to end with this slide. Henry Simons was one of the architects of the narrow banking proposal together with Irving Fisher. Henry Simons also happened to be the teacher of Hyman Minsky. Now, Henry Simons was also an extreme libertarian, so he was a pretty weird guy. But if you've read some of the things here, you will note that he actually had a proposal which was quite radical, which was to ban short-term lending. And he said, a stable system can only survive on equity and perpetuals, meaning, perpetuals being long-term bonds or whatever. And so we need more equity and we need more long-term investment. And on that note, I'll end. Thank you.
Very quickly, 3 points. Thorvald rightly points out that I put banks at the center of this story of shadow money creation, and that's inconsistent with the FSB approach. And I blame the FSB, not myself, for that. Thank you. I know who applauded. He's a friend of mine. Why am I saying that? Now, joking aside, the FSB is an international organization where a lot of politics is poured into discussing how to frame things. And I think if you read very carefully through the lines, it's very clear, the FSB as well, that the banks are part of the system. They are fundamental to the system in a variety of ways. But the sort of lobbying power of banks sometimes is quite impressive, and I think that's one of the reasons why banks are not so fundamental. And if you look very carefully at how the FSB measurements of shadow banking have evolved over time, they're moving much more into an institution-based approach that talks about non-bank financial intermediaries, and they're dropping the activities-based approach, because once you talk activities, you talk money, you talk monetary consequences, and that's a much sort of steeper hill to climb and a much more radical propositions to consider. So I think the reason is, so there are political reasons, but there are also theoretical reasons in the sense that until very recently, the monetary implications of shadow banking were not considered carefully. This is why I thank INET for giving us the grant, because this is what we wanted to do there, to say this is not just about kind of tracing perimeters and finding out exciting new institutions with complicated acronyms, but it's about money creation. And money creation that involves promises to convert at par new money into old money has to go through the balance sheet of the commercial banking sector, and it goes in very complicated ways. I'm writing a book about this. Please buy it when it's out, maybe in next century. And then very quickly on the role of government debt, I try to explain this to my poor students, the advantage of being in an institution like mine that encourages heterodox economics. Is that they allow me to teach stuff that is not necessarily in mainstream macro. So I get my students to read this and try to work out how it's linked to macroeconomics and finance in general, and I try to explain it to them. So one way that I did in relationship to government debt is to talk about Stranger Things. Have you seen Stranger Things? No? Okay, well, maybe okay, so Stranger Things is like, it's a Netflix show that deals with some children who are finding a parallel universe that interacts all of a sudden with theirs, called the Upside Down, right? And this parallel universe looks very much like our universe, but it has a Demogorgon, like a supernatural evil creature. And so I try to explain to my students that we can think about shadow banking as the Demogorgon of like the banking that we see. And that Demogorgon is making something very different with government debt, right? Because in the real world, government debt looks like something that is created in order to bridge the gap between how much the government spends and how much it earns. And I know there are MMT people in the room, so I am treading very carefully here. So, but in the Upside Down, there is a financial role for government debt. Government debt has a financial life, and that financial life is very strange, right? And that financial life has to do with shadow money creation, but it kind of also changes the way in which government debt works in the real life. So the Demogorgon of shadow banking is invading, as in Stranger Things. If you watch it, is invading the real world, and it's making everybody, well, not everybody, but Thorvald and I for sure, apprehensive. So that's the last one. Yeah, no, I'll stop here. The why not money market funds and asset-backed commercial paper.
This
is
it.
A very boring technical discussion, but I think I'm right.
Good. So do we have any comments or questions? One over here. Okay. Then we have another one up here. Good.
Thank you very much. I'm not sure I managed to follow all of it, but I'm trying to understand how this works. I guess my question is sort of see if I've sort of how much I've understood of it. And it's interesting, you know, in Rana Forohar's book, Makers and Takers, she writes about how now the real economy only represents 15% of the financial economy. And as Anne Pettifor mentioned earlier, it's about, you know, it's interesting to understand how the financial sector is in an extracting resources from the real economy. But then my question, when you talk about this, and you talk about all these new money creation that shadow banking represents, to what extent are they actually taking resources from the real economy? And to what extent are they simply just creating new money, speculating it back and forth within the financial system, making a lot of people very rich, and then it's mostly when it crashes that it starts to really affect the 15% of the real economy.
Thank you for a very interesting presentation. My name is Javier Solana. I'm a lecturer in commercial law at the University of Glasgow. And I was interested by something that you mentioned, Daniela, about the equivalence or the connection between the assets and the liabilities in a shadow bank model, or in a shadow bank balance sheet, and how collateral was the mechanism that allows us to connect those two elements. And when I think about that, I think about a zero-sum game, in the sense that we only have so many securities or so many safe assets. So to my mind, the ability to reuse those securities, which is something that Thorvald mentioned afterwards, is what's allowing the huge expansion of the shadow banking system. So I would like to know your opinion on the idea of making this an actual zero-sum game, so that we only have physical securities, which are not really physical, but existing securities as the main source of collateralization in the shadow banking system, so that doesn't grow out of control.
And then we have Benjamin in the middle here. I don't know if you're going to pass it on or...
Ready? Yep.
Catch?
No, you, catch.
Well.
Thank you. A quick question. Zoltan Pojar, in his latest Global Money Notes, have been arguing that the shadow banking system, as we know, is going to look very different in the future, and in particular that the public sector will have a much bigger role. And it seems to be somewhat different from your dystopic view of a pure market-based and perhaps private-led system. Do you think there is any value in this perspective, and do you think this goes against your own views, or is somewhat complementary?
All right. So I'll give the word to Thorvald first to comment quickly, and then Daniela.
Just 2 points on the zero-sum game and what might happen of value extraction, Ebba. I think we discussed this over lunch as well, and I think it's, as you correctly pointed out, it's when there is a crash and there is a request for official assistance that you get the taxpayers involved, and that, for me, as I said, is enough to indicate that there should be some way of constraining the system. And then I would add that there is, in fact, a lot of things going on under the umbrella of FSB on rules for collateral reuse, hypothecation, margin and haircuts. But in my view, those are, probably not too radical enough to address the enormous growth of the system. So, I mean, that's where I am. I think, it's not going to get at the system we want. Thank you.
Yeah?
Yeah.
Okay, so maybe to go in the order of the questions, first, Ebba, I sometimes wonder, and I'm not sure what I think, in the sense that I think there is a functional story here, in the sense that this type of money creation is functional for organizing the financial system around securities markets. And to me, the question is, do we want to organize financial systems around securities markets? And have we thought very carefully through what are the consequences of that system? Now, if I look at the first historical experience of organizing financial systems around securities markets, you have to look at this is driving me crazy. You have to look at the US financial system before the creation of the Fed, right? Which is very fascinating, because we have a story of shadow money creation there, where the very strange idiosyncrasies of the US banking system sort of worked out that credit creation happened in New York through securities markets, first in railroads, then in industrial bonds, and they were funded by shadow money issued by brokers and financed by banks, New York banks collecting money from country banks, right? So this system existed before the creation of the Fed, and that brings all sorts of interesting questions about the role of central banks. But what this says to me is that it is a system that this type of money creation is functional to the way in which we choose to design the financial sector. And that is the political choice here, is whether we prefer to organize financial systems around patient banks, or we want to organize them around securities markets. Of course, I think this system is much more fragile, and the leverage and the speculative aspects are much easier to work out. I mean, in a sense, also banking is a speculative activity, because you grow your balance sheet with little capital and try to make more profit. Shadow banking is not fundamentally different in that way. We just want to think that somehow we can convince banks to be more patient, to have a 9 to 3 timetable, and for bankers to play golf afterwards. Well, this is, there is some satisfaction for me that bankers work much longer hours in the shadow money world, because it's a world where time is measured in minutes and seconds rather than mornings. So So I'm not sure how to answer that question. I think also we have to be careful how we measure values, because 15% of real economy to financial economy probably captures derivatives, and there how to net or not derivatives is a long conversation. So I'm not sure. I think the more valid question is to think politically about what it means to organize your financial system and the relationship to the real economy through securities markets. And I personally, my politics, so yeah, as all economists, I do have politics. My politics is from the left, is progressive in the left sense, and I would prefer that we do not organize financial systems around securities markets, that the global political economy is not organized so that Latin American or African farmers can only access credit from Dutch pension fund through some very complicated financial engineering, but they could do it from their own state development bank there in their own country. Now, why this doesn't happen is a long, complicated discussion, but it seems to me that the political choices that we are looking at have to be discussed in relationship with the very technicalities of what Thorvald and I went through. The zero-sum game, well, I mean, we can. I didn't think there was a point to show this, but you're right. There is a reason why this system of shadow money creation is funding securities of very different natures with government bonds, because government bonds can be reused. And the reason for that is simply because monetizing or trying to monetize credit happens in the cheapest way possible for banks, right? And it's much cheaper to monetize or to create shadow money with government debt, because government debt, for a variety of reasons, trades in much more liquid markets. So preserving moneyness is cheaper, let's put it this way. There were attempts to try to stop the reuse of government debts and the reuse of collateral in general, but the shadow money lobby, there is such a thing as a shadow money lobby. It's called the repo lobby, or the International Capital Markets Association, the European Repo and Collateral Council. The repo lobby had a very good strategy, and they said, okay, we're going to go and knock on the door of ministries of finance, and we have one who used to be a minister of finance in the room, and ask them what will happen if you stop reuse of sovereign bonds in terms of market liquidity. And there again, it takes us back to the long discussion about what are the political choices we make in order to organize our financial system. Because if we choose to constrain governments through bond markets, through sovereign bond markets that are also used in shadow money creation, we are making political choices that constrain severely the ability of the state to impose rules on shadow money creators, because of this symbolism or symbiosis between shadow money and government bond markets, right? So yes, I think the answer is just read more. Zoltan Poșar, I think I'm not that I mean, the footprint of the state in shadow money creation is very clear. The extent to which the state is actually in control of these processes through either the central bank or the treasury is a very different question. And I have very little optimism about the extent to which the state in the future will be, just by looking at the way in which the pressures of international financial institutions in developing countries under the agenda of constructing local currency bond markets, the pressures are to liberate shadow money from the chains that have been put on it since the global financial crisis. So changing the operational interest rate target from an unsecured rate to a repo rate, it doesn't mean to me that this is, the state is finding its feet again. Quite the opposite.
Thank you. I believe you have some gifts.
Some Norwegian chocolate. Thank you so much.
Thank you.